guest, Bill McNabb, who, as you say, is the CEO of Vanguard, and they have just launched their offices here in Shanghai. It's a wholly owned foreign enterprise, and it expands your footprint here in China. But it's coming, obviously, at a difficult time. We've seen the sell-offs in the bond markets, the equity markets, as part of this deleveraging campaign starts to bite here. And, of course, most recently, we've had the credit downgrade by Moody's for China over their concerns about the country's debt profile. What kind of challenges does that backdrop pose to your business here and your expansion plans for China?
You know, Tom, it's an interesting thing. I think being from Vanguard, I'm by nature a contrarian. So I think the fact that all that's happening is actually a good thing for us because we have a very long view. And so we'd been studying coming to Shanghai for quite some time. We'd expanded pretty dramatically in Hong Kong. We have a representative office in Beijing. And the idea of coming and establishing a WFOE here in a free trade zone to learn more so that we can better serve our clients, not only here in China, but also globally by understanding the economy a little bit more broadly.
And what's the next logical step then for Vanguard in China? Is it setting up a private fund? And what kind of clients are you targeting?
Yeah, so it's a great question. And the short answer is we don't know yet. You know, what we're thinking about, we have some large institutional clients. And we're looking at, are there ways down the road as the markets open up that we could actually serve a broader constituency, maybe even individual investors, but it would probably be through some different kind of platform than exists today. But the only way to really understand that is to be here. And so a lot of what we've instructed the team is, you know, use your time here to better get to know the markets, better get to know the regulators, better get to know, serve our clients, if you will, but also look for these opportunities if there are opportunities to expand. And I'm optimistic, but it's going to take some time. All the factors that you described are certainly going to be constraints in the short run.
Are you able to give us any kind of time frame on where you might drive this? I know, you know, retail investors in China, if you could get a slice of that market, that would be huge. But as you point to, it's going to be a long time, isn't it? But you've been having conversations with the regulators here. What have they been saying to you?
All the regulators tell us that what they really want to see are more open markets, more open capital flow, and very importantly, the development of a more sophisticated retail investor base. You know, today, as you probably know, retail investors tend to buy and trade individual securities pretty aggressively. And the idea of actually having funds for them to invest in and take a longer-term perspective really hasn't taken hold yet. I think the regulators would actually like that from a capital markets development standpoint. And I've heard over and over again from, you know, my contacts here that the a good retail capital market space would add stability to the market and would also add sort of more sustainable growth opportunities for the market. So that's probably not a 12-month thing, but maybe 3 to 5 years you begin to see these things evolve. We're real students. So if you look at what Alibaba did in the money market fund business, you know, just 3 years ago, they launched an online money market fund, very novel approach. It's the largest money market fund in the world, incredible uptake, and no one would have predicted that that could happen. And so that's the kind of thing that you know, as a student, you really look at and you say, I wonder if we can figure out how to do something.
Another question on many people's lips here in China is whether the MSCI includes the A shares in their next decision, which I believe is sometime in June. Is it time for that to happen?
I think it's time for that to happen. I don't have any particular insight. As you may know, we established A shares in our emerging markets fund, which uses a different benchmark provider, FTSE. And the FTSE benchmark includes now 1,900 listed companies in the A shares market. It's been a fantastic thing for our shareholders, despite the fact that the markets have been up and down quite a bit. Just getting exposure to this economy that way in the largest emerging market fund in the world, we think was really important.
Let me switch focus to the UK, if I may, because
Sure.
of course you caused some waves there when you opened up your online presence to retail investors, and some of the incumbents there took a bit of a hit in terms of their stock prices. Do you foresee now a price war amongst asset managers in the UK as a result of your presence there?
I don't know if it'll be a price war, but we hope people are going to pay more attention to price. You know, at the end of the day, what's really important for investment firms always to remember is it's not our money. It's our clients' money. And I tend to think of fees not as basis points or even dollars. I think of them as a percentage of return. And if you think about, in an environment where, bonds are 2 to 3% over the next decade and stocks maybe are 6 or 7, if you're charging your clients 1% or 1.5%, that could be 25% of their total return or more. That doesn't seem right to us. So if that's going to cause some waves, I'm happy to cause those waves.
Can you give us some idea as to what you might be targeting in the UK over a 2 to 3 year period in terms of inflows, and how much you might divide that up between, or expect that to be divided up between the passive side and the active side?
Yeah, so we don't even have a target. All we're trying to do is try to build momentum. The first day was incredible. I was getting calls like every 15 minutes from the team. They were so excited at all the online activity that was occurring. I would imagine it's going to be a slow build. It takes time for investors to think about using technology the way we're deploying it there. In Great Britain, it's not been a technology-based investment culture. Most of what's done is still through pretty traditional distribution channels. In the U.S., obviously 90+% of what we see comes online. So we think it's going to be slow, but I hope over the next 2 to 3 years we'd see several billion pounds invested. On the equity side, it's initially we're going to have both active and passive, and on the fixed interest side, the same thing. And my guess is there'll be a better balance between that than there has been in the U.S. In the U.S., it's been almost all passive, as you know. But I do think in the UK there's still a strong demand for active. And for us, we've never been, we're not anti-active. Actually, a third of our assets roughly are active. We're just anti-high-cost active.
What about consolidation in the asset management sector? A lot of analysts saying that is now inevitable. It's going to happen. What's your view?
I would agree with that conclusion. We think scale is really important. If you look at Vanguard US and you just look at the decline in our expense ratio, that's kind of a window into the economies of scale that can be gained. And, I think other people are looking at it saying the only way to compete with that is actually to be pretty significantly large. It's really the only way you can both invest in the service side and keep your prices really competitive.
We've seen something of a rotation into European stocks. Yeah. There's some positivity there with the fundamentals, some of the political risk possibly being taken out, the valuation's relatively cheap. Do you expect to see a near-term pullback, or is there momentum to keep that going?
This is a question a lot of our analysts are looking at as well. I would suspect that you're going to continue to see some interest in Europe. The U.S. is very, very highly valued. The only sector, broad sector of the market that seems cheap is the emerging market side. And of course, everybody is trying to figure out China's, next 12 to 18 to 24 months. And I think that's holding people back a little bit in terms of investing in the emerging side. So Europe ends up being kind of the favorite place.
Briefly, Bill, on the US, we've got the Fed tussling this dilemma between the improved job market but this weak inflation. Then you've got the Trump agenda potentially derailed or being slowed. What's your view on where the US goes for the rest of the year?
Yeah, so I think the U.S. market is actually really fully valued right now. And, the thing we worry about is the market has essentially made assumptions that tax reform occurs, infrastructure spending goes up, and regulation is tamped down a little bit. The probabilities of any or all of those things happening over the next 6 months are pretty low. And that would tend to disappoint investors. So we're very cautious about the U.S. right now.